Welcome back to the deep dive. Today we are cutting straight through the noise to look at Darden Restaurants.
Right, because they've managed to do something pretty remarkable in, a really tough environment for consumers.
Exactly. We're going deep into their fiscal Q2 2026 numbers, looking at the whole portfolio, Olive Garden, LongHorn, all of it.
And this is a crucial one. Darden is really the bellwether for this whole space, for casual and fine dining.
And they're staring down these historically high inflation numbers, especially for beef.
Yet they're still outperforming. So our mission here is to figure out how. How are they pulling off this balancing act?
Okay, so let's just jump right in with the big picture numbers.
Yeah.
Q2 was, it was strong.
Oh, absolutely. Total sales were up 7.3% to $3.1 billion.
And the big one, same restaurant sales, or SRS.
Yep, that was up 4.3%. And to put that in perspective, that beat the industry benchmark by 300 basis points.
Okay, hold on. Let's just quickly define that. So when we say basis points, we're talking about hundredths of a percent.
Right.
Cool. So 300 basis points means they're growing 3 full percentage points faster than their competition. That's market share theft.
It is. It's pure market share theft.
Huh.
People are choosing to go to Darden's restaurants over other places. And on top of that, adjusted earnings per share were solid at $2.08.
All right, so here's where it gets really, really interesting. They posted these great sales numbers, even with what management called stronger than anticipated commodity headwinds.
Which is really code for beef is insanely expensive right now.
Right, and that sets up the core conflict. Strong performance, but right in the teeth of historically high beef prices.
And this is where they made a huge, very intentional strategic bet. Darden decided to price their menus 130 basis points below the rate of inflation.
So they're eating the cost.
They are absolutely eating the cost.
Right.
They are sacrificing margin in the short term, basically as an investment in guest value. They believe that'll keep people coming in the door for the long haul.
That sounds like a really risky move. How do they make sure that this doesn't just become a permanent drag on their margins?
Yeah.
That they won't have to jack up prices later and scare everyone away?
Well, they believe they have a moat. Their whole strategy is what they call being brilliant with the basics.
Okay.
And that's built on 4, core competitive advantages that let them make a bet like this.
Let's break those down, because that seems to be the key to this whole thing.
So number 1 is just the sheer power of scale. They're huge. They can buy for Olive Garden, for LongHorn, for everyone all at once.
And get better prices than the little guys.
Exactly. It lets them avoid passing every single cost increase onto you, the guest. The second one, and this is critical right now, is the breadth of portfolio.
So having all those different brands under one roof.
Right. It means the whole company can handle a shock, even if one brand is, and this is a direct quote, overly impacted by a single commodity.
A very clear nod to LongHorn and beef. A crystal clear nod. The other brands, provide air cover. So Olive Garden's success helps pay for the value investment they're making at LongHorn.
That makes a lot of sense. So it's an insurance policy, and the last 2 advantages are more about execution, right?
Correct. Extensive data and insights, they know what's working, and the quality of their employees. They kept bringing this up.
The people focus.
Yeah, they even quoted their first CEO, Joe Lee, who said, "If you take care of your people, they will take care of your guests." And it's not just talk. They have record low turnover, which in the restaurant business is a massive, massive advantage.
And you can see that advantage translate directly into the numbers, especially when you look at the star of the show, Olive Garden.
Olive Garden is just an operational masterpiece right now. They delivered 4.7% SRS growth.
So that's outperforming the industry by 340 basis points. That's huge.
It's huge. And here's the kicker. Their segment profit margin was 21.8%. It actually went up.
Wait, their margin went up while the company as a whole is pricing below inflation? How? It's a mix of things. Operational efficiency is a big one. When you have low turnover, you're not constantly training new people.
Wasting fewer labor hours.
Precisely. And then there's just the power of their value proposition. It drives incredible volume.
Which, of course, brings us to the never-ending pasta bowl.
The icon of value.
Yeah.
For the 4th year in a row, the price was still $13.99.
Wow.
And get this, they set a record high for the refill rate.
So people are really taking them up on the never-ending part.
More than ever. It shows you that their guests are feeling the pressure out there and are trying to maximize every dollar. It's a fascinating insight.
It is. Now, beyond just the pasta, they're also using tech in a really smart way with delivery.
Yeah, the Uber Direct partnership, it now makes up 4% of their total sales.
Yeah.
And the key thing is that about half of that business is incremental.
Meaning these are new customers, not just existing diners who decided to stay home.
Exactly, and management said this channel brings in younger, more affluent guests who want convenience. Insistingly, they actually have a higher average check than dine-in guests.
So the profits from the high-check delivery customer are helping subsidize the value for the in-restaurant customer. That's a really smart sort of internal ecosystem.
It is, and the success of delivery is actually helping them fund another investment in value, which is this new lighter portions menu.
This is an interesting one. So they take existing dishes, just make them smaller and cheaper.
That's the idea, 7 dishes.
Yeah.
The goal is just to give people more choice, maybe someone who wants a smaller meal or a lower price point.
And is it working?
The early signs are really good. They're seeing a double-digit jump in how affordable guests think they are, and those guests are coming back more often. It was in about 40% of restaurants in Q2, but it's going system-wide by January.
Now, management was pretty upfront that this causes some check mix pressure,
Right.
which just means the average check goes down a little because people are picking a cheaper item. Yeah.
That's right. It was a drag of about 20 basis points in Q2. But again, they see that as a worthwhile investment for long-term traffic and, just building that value perception.
They're also clearly listening to their fans online. They brought back a couple of old favorites.
They did. Ravioli di portobello and braised beef tortelloni. Apparently, thousands of people were asking. There were even online petitions. It's a great example of them using that data advantage they talked about.
Okay, so let's pivot from the powerhouse that is Olive Garden to the place where that air cover we talked about is desperately needed, LongHorn Steakhouse.
Yeah, this is where the story gets tough. Operationally, LongHorn is executing flawlessly.
Their numbers look great on the surface.
They do, 5.9% SRS growth. They hit an all-time high score for cooking steaks correctly. They have record low employee turnover, but the commodity market is just crushing their margins.
And this is where that core contract really comes into focus. Their segment profit margin fell all the way to 16.2%. Why is the underpricing so extreme here?
Because it's all about beef. Management said that at LongHorn specifically, they were pricing an incredible 320 basis points below inflation.
Wow, 320. That is a massive, massive subsidy.
It's a huge bet on guest loyalty, and it's a bet they can only make because Olive Garden is doing so well and providing that portfolio air cover.
But isn't there a risk that you're training your LongHorn guests to expect cheap steak forever? I mean, what happens when you eventually have to raise prices?
That's the strategic gamble. They're betting this is a temporary shock. And the source material actually explains what's going on. The supply is constrained because of packer cutbacks, but also something very specific.
What's that?
Halted cattle imports from Mexico because of a screwworm outbreak.
Screwworms? You're telling me screwworms are impacting Darden's Q2 earnings report?
It's a wild headline, but it shows you how fragile these global supply chains can be.
It really does. So is there any light at the end of the tunnel here on beef prices?
There are some green shoots. Retail demand is finally starting to fall off. In November, volume was down 14%.
So people are finally balking at grocery store prices for steak.
Exactly, which should eventually help wholesale prices. And Darden has already locked in prices for about 45% of their needs for the rest of the year, so they've managed the risk for now.
Okay, let's move on from the steak drama and look at the other parts of the portfolio. Fine dining and the other business segment.
Right, so other business includes brands like Yard House and Cheddar's. That segment grew SRS by 3.1%.
And Yard House was a standout.
Yard House did great, yeah. They had their annual Oktoberfest event with this super popular $5 refillable beer stein promotion.
That'll drive some traffic.
It definitely did. And Yard House is also important because they're next in line to start rolling out that Uber Direct delivery service.
And what about the high end? The fine dining segment Ruth's Chris, the Capitol Grill. You'd think those customers would be immune to inflation.
You would think, but the data says price certainty still matters. The segment grew SRS by just 0.8%.
Pretty modest.
Very modest, and their successes were all value-driven. Ruth's Chris drove traffic with a $55 three-course special. The Capitol Grill did it with a $35 Wagyu and wine event.
So even at the premium level, a good deal is still a good deal.
It turns out everyone likes to feel like they're getting a good deal. It just works across the entire price spectrum.
And what's the latest on Cheddar's? That brand's been a work in progress for a while now.
It's finally stabilizing. It grew SRS, and most importantly, they got their team member turnover way down, closer to the Darden average. Management sounds confident that it can be a real growth engine now that the labor issues are getting fixed.
That brings us to the broader financials and the outlook. Let's start with labor, which is usually The other big headache besides commodities?
And this was another sort of surprising bright spot for Darden. Total labor inflation was only 3.3%.
That's actually lower than their pre-COVID average.
It is.
How do they manage that?
It comes right back to that low turnover. When you keep your experienced people, you get huge productivity gains. You're more efficient. And those gains were actually enough to offset the fact they were pricing below labor inflation. It's that take care of your people philosophy paying off in hard dollars.
That is a real competitive advantage. What about their plans for growth and capital?
They're still very active. They gave back almost $400 million to shareholders in Q2 alone through dividends and buybacks.
Wow.
And they're still building. They upped their target to between 65 and 70 new restaurants this fiscal year, so the pipeline is strong.
So after all that, with all this intentional margin pressure, what does the full year forecast look like?
It's still very confident. They're guiding to total sales growth of around 8.5 to 9.3%, with SRS growth between 3.5 and 4.3%.
Inflation.
They see total inflation around 3.5%, and here's the key. They expect that gap, between their pricing and inflation, to narrow a lot in the second half of the year. They think it'll pretty much close by the fourth quarter.
So the bet is they can absorb this temporary beef crisis, use the value to steal customers now, and then when things normalize, their margins will snap right back.
That's the strategy in a nutshell. Accept the short-term pain for long-term market share gain. And so far, it seems to be working across the entire portfolio, from Olive Garden all the way up to Ruth's Chris.
So the entire Darden playbook is built on this long-term view. Investing in value, investing in people. They're even accelerating the rollout of that lower-check, lighter portions menu. But the huge investment at LongHorn, pricing 320 basis points below inflation, that can't last forever.
It can't.
Which brings us to the final thought for you, the listener, to really chew on. How critical is the eventual recovery of beef prices to actually validating this whole strategy? Or can their operational execution, can being brilliant with the basics, truly keep them on top no matter how long the commodity markets stay this crazy?
It's the ultimate stress test. Can great management actually beat the screwworm?
And that's what we'll leave you with. Thanks for joining us for this deep dive into Darden's performance.